Welcome to Striking Options, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Scott Bauer. Hey there, Scott.
Jeff, how are you?
I'm doing great. It's a really interesting week. We're seeing earnings season wind down, but continued trade tariff conversations dominate the market. What's your focus this week as we do see all-time highs once again in the S&P 500?
Yeah, right. On again, off again with what may happen with phase one. Like you said, earnings season's wrapping down. We got speak out of Jerome Powell. So, really the rest of the year here, I think, is going to be focused on what happens with the U.S. and China.
And in the event we do get some type of phase one deal, that is going to be accommodative and constructive for the market, correct?
Absolutely.
All right, let's get into this first lightning round. You ready?
All right.
New all-time highs. Well, it's really interesting to see. This is the sixth week in a row the S&P 500 has continued to move higher. Certainly there's a lot of moving parts. There's optimism about the U.S.-China trade tariff conversation, but it seems to be Fed-driven. And here we are at equities all-time high. How could you potentially present a trade example that could mitigate risk in the event we don't see the Santa Claus rally that we're all expecting?
Absolutely, Jeff. It's really something to take a look at, especially with volatility levels much lower than they have been. So I'm looking to buy a week 4 3,050, 3,000 put spread with the November 22nd expiration in the E-mini S&P 500. This put spread costs an investor about $209, and the December futures were trading right at 30.92.5 when this trade example was priced.
And we talk about at-the-money volatility a lot here on Striking Options, Scott, and right now that at-the-money volatility was under 10, about 9.5, and that's really important to understand what you're paying or potentially selling when we look at all the variety of spreads like we do here on Striking Options. But it's interesting. In the event the market goes up 3, 4, 5 more percent, like some participants are expecting with this Christmas rally, you're defining what you're paying for this downside potential pullback. And maybe it's not a pullback. Maybe it's just out of gas after 6 weeks of going up.
And that's such an important point, is this is defined risk, and that risk is lower because the volatility and the premium levels are lower.
When people don't talk enough about risk mitigation, but here on Striking Options, that is our bread and butter, Scott.
Absolutely it is.
Let's get into the second lightning round. You ready?
Absolutely.
Gold. Well, gold certainly has been an interesting trade. We saw the U.S. dollar move around a lot. It has been range bound, but gold cracked that $1,500 level, and all of a sudden here, we're testing $1,450. We actually dipped under $1,450, and if the folks remember, last week we talked about selling that put spread, that $1,450 level. Now we've seen a little rebound in gold as we see Jerome Powell come back and save the gold market.
Absolutely, and we've talked so much about the range, not just in gold, but other commodities as well. And so far in gold, it's really adhered to that range of roughly $1,450 to $1,500.
And I think the approach when we talk about do you sell a spread, do you buy a spread, last week was a great example that we saw elevated option premium. We were very aggressive selling that at the money, that $1,450 level. We sold that, collected that premium. But now I want to approach it in a little bit different manner. I want to be buying an upside call spread. Explain a little bit more about how we approach premium buying.
Absolutely.
Or selling.
Absolutely. So, just as in the other example here, when volatility gets extended or gets higher, that makes options more expensive, more premium. When volatility comes down and gets less expensive, that reduces the cost of option premium. And right now we're in a situation where volatility in gold is much lower than it has been over the last week, over the last month even.
Well, you put it on the rim for me there, Scott. So the trade example I want to utilize, I want to be a buyer of the week 4 gold 1,525 call spread. That's going to expire on November 22nd as well. And the call spread is going to cost an investor about $90.
Absolutely, and the DEES futures here were trading 1466.6, and just like we just talked about, the at-the-money volatility was only 10.
Well, Scott, I want to thank you for coming on Striking Options, and make sure you tune in every week as we'll continue to strike options.